Welcome to Bloomberg Markets. I'm Scarlett Fu. We are seeing red on the equity screen today. The S&P 500 retreating from a record high, falling the most since April, even after a cool inflation report that paves the way for the Federal Reserve to cut interest rates. So let's get you a quick check on the markets right now. We're starting with the S&P 500. You can see they're losing 0.9%. This marks the first pullback in almost 2 weeks, and a pretty meaningful decline at that. We are seeing a rotation out of some big cap growth names like technology, like communication services, like consumer discretionary, into things like REITs, utilities, industrials, and materials. For the NASDAQ 100, which of course is made up of those big cap tech names, an even larger decline of 2%. All the Magnificent Seven names, for instance, are falling. And within the Philadelphia Semiconductor Index, a drop of 3.25%, with all 30 names in the red. Now, what's interesting, of course, is part of that rotation going into the old economy names. The Dow Industrial is up by 0.2%. It is the outperformer here, with names like 3M, Dow, Home Depot, and Caterpillar advancing. Let's take a look at the bond market, starting with the 10-year yield. It is hitting its lowest since March, and you can see that big intraday decline right around 8:30 a.m. when the CPI numbers crossed. We've seen U.S. Treasury auctions get pretty solid demand so far this week. If we switch it up and take a look at dollar yen, again, an intraday chart, you can see a similar movement. Of course, the inverse here, the dollar losing ground. Of course, we're quoting this as Japanese yen, so the yen rising in value here, with the dollar losing ground against most major currencies. The slowing inflation data out of the U.S. this morning boosting the odds of a rate cut later this year. But the yen also stronger here on the back of large offers in the brokers market, as well as stop loss sales. And that is increasing speculation about official intervention from Japan to support its currency. That's been a theme in the currency market for a couple of weeks now. Now, speaking of inflation, data showed that it cooled broadly in June, driven by a long-awaited slowdown in housing costs. So what does this mean for Fed policy? Joining us now is Yelena Shulyatyeva. She is senior U.S. economist over at BNP Paribas. Yelena, thank you so much for joining us. Really appreciate your taking the time. The headline CPI number fell unexpectedly. There is a bit of whiff of deflation in the air. So let's just unpack the numbers as we got them. How broad was the weakness in pricing? We mentioned certainly housing was one component, but give us the overview.
Sure. So I think it's too early to worry about deflation here, of course. But I think there were two things that I would like to say about it. So first, there was some normalization in some very abrupt moves that we saw in the May report. So you mentioned housing, right? And housing was a very strange increase in housing costs in May, which normalized in the June report. But even despite all these different categories normalizing, such as car insurance, for example, also normalized from a very strange decline in the previous months, it was a sense of a broad-based cooling, particularly in the services sector. So I'd say it's a very welcome development. We see that finally inflation is a lagging indicator, of course. It's finally starting to catch down to developments in the economy and in the labor market.
Yeah, we had already seen that slowdown take place in the goods. So to see it start to really take root in services is encouraging, certainly for the Fed. We know that Jay Powell told Congress this week that Fed officials need to gain more confidence before cutting. But confidence is qualitative, it's not quantitative. So to what extent does this morning's data point, the June inflation report at large, provide some of that confidence?
It will definitely boost their confidence. So, the labor market is where it needs to be, right? And probably even slightly weaker than the Fed would like to see. So if you simply look at the unemployment rate, 4.1% we saw in the June jobs report is already slightly higher than the Fed penciled into their June summary of economic projections. Today's data is tracking such that we may actually undershoot 2.8% year-over-year growth in PCE inflation that the Fed was expecting by year end. So that all obviously increases the chances of an earlier rate cut.
Okay, when we say earlier rate cut, does this data put a July rate cut on the table?
No, not too early. Too early. I think between now and the July FOMC meeting, there's simply not that much major data that could really push this forward. And I think the data so far in terms of the labor market and inflation is really something that the Fed would like to see to kind of like for them to proceed as they expected and start cutting rates later this year. I would say that, going in July would spook the markets and would just mean that the Fed is seeing something that we don't see. And that's not what the Fed wants to do.
Okay, so maybe they use the July 31st meeting as a way to signal that things are moving in line for a September cut. When the Fed does start cutting, Yelena, David Rosenberg, an economist, says the first 250 basis points of the rate cutting cycle will mainly remove the excessive restraint as opposed to providing any real economic stimulus. What's your take on that?
I think that Powell will probably make a big announcement at the Jackson Hole meeting at the end of August. But in terms of how this will affect the trajectory of real interest rates, I agree. I think the Fed just needs to push nominal interest rates a bit lower so that real rates don't make more restraint for the economy. I think that's the key here. This cycle, this cutting cycle, it's not an easing cycle. It's a cutting cycle. And the Fed will need to do that in order to not over tighten, so to say. It will be different, most likely, from the past cutting cycles that were driven by weakening economy into a recession. So
okay.
that's probably not what we're looking for.
All right, important distinction there. Yelena, thank you so much. Yelena Shulyatyeva is senior U.S. economist over at BNP Paribas. Coming up, we're going to get a wrap on NATO because Richard Haass will be joining us to discuss the future of the alliance and the state of geopolitical tensions as everyone watches President Biden to see how he's faring at this summit. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We're paying attention to the markets, of course, which are in the red right now after a cooler than expected inflation report. We'll get to that more later on, but we do want to talk about what's happening in Washington. NATO issued a declaration on Wednesday night calling out China's military support for Russia in Ukraine. The declaration described China as a decisive enabler of Russia's war against Ukraine. This, of course, as the campaign, Biden's campaign, fights an intra-party uprising over his fitness for office. Let's bring in now Bloomberg Balance of Power co-host Kelly Lines with more. So, Kelly, just give us the big takeaways so far from NATO.
Well, certainly there have been some deliverables from this summit that's now its third day here in Washington, Scarlett, including additional aid for Ukraine, which was announced by President Biden at the beginning of the summit on Tuesday. 5 long-range air defense systems, dozens of other shorter-range air defense, something that Ukraine had desperately wanted, and conversation as well around an eventual path for Ukraine to join NATO, though the conflict with Russia does need to be at its end in order for that to actually happen, considering allies would be inherently drawn into that active conflict if it were to happen in the near term. By and large, though, a lot of this conversation at the NATO summit has been dominated by questions around the presidency of the United States, not just who's going to win in November as allies brace for the potential return of Donald Trump and what that could mean for the U.S.'s relationship with the alliance and how the nature of it could change, but also just the acuity and ability of President Biden to be a leader of the free world at this time when so many questions are swirling around his age, which is why his press conference tonight, which we're expecting at 6:30 p.m. Eastern time, is going to be absolutely critical, as he is not going to be reading off a teleprompter. He is going to be thinking off the top of his head and ad-libbing answers to questions from the press, it's really hard to overstate how critical a moment this is for him, Scarlett.
Yeah, so no safety net for President Biden with the world watching. Of course, we also have more prominent Democrats coming out and speaking out, urging President Biden to step aside from the presidential race, including the senator from Vermont.
Yes, this one is critical because this is the first time we have seen a Democratic member of the Senate call for Biden to step out. But Senator Peter Welch has done that in a Washington Post op-ed overnight. And it's noteworthy that Biden campaign aides, some of the most senior officials, including the likes of Steve Ricchetti, this hour are set to meet with Senate Democrats to kind of try to stem the bleeding, if you will. Of course, while we've only seen one senator at this point call for Biden to drop out publicly, we have seen a number of members of the House, now up to 10, who have publicly called for him to step out. Just today, a frontliner, if you will, a Democrat from Michigan, Hillary Schulten, has joined the chorus. Earl Blumenauer called for him to drop out overnight as well. So they have at this point not proven that they've really stopped the bleeding. And there's a question, once NATO is over, what could happen then? Because House Speaker Emerita Nancy Pelosi on MSNBC yesterday not only declined to full-throatedly endorse Biden's re-election effort, saying it's his decision whether or not to stay in the race, she also encouraged everyone to essentially pipe down until NATO is over. And there's a question as to whether or not that was a signal to her Democratic caucus that they just need to be biding their time until all the pomp and circumstance is over.
Yeah, well, in the meantime, there's still a lot of pomp and circumstance to go. Bloomberg Balance of Power co-host Kayleigh Lines, and of course, you'll want to check her out on Balance of Power later this afternoon and this evening. All right, let's discuss all of this now with former U.S. National Security Senior Director and President Emeritus of the Council on Foreign Relations, Richard Haass. Richard now serves as Senior Counselor at Centerview Partners. Richard, thank you so much for speaking with us today. As Kayleigh just kind of gave us the rundown here on what was accomplished at NATO so far, we know that the alliance said Ukraine's future is in the alliance, and we will continue to support it on its irreversible path to membership. Can you translate that into plain English for us? What does that actually mean? What does that actual support entail?
Well, the support is modest. It's another, $40–50 billion in aid, some useful weapons, particularly in the area of air defense, which should help blunt some of the Russian attacks. Putting Ukraine on a quote-unquote irreversible path to membership doesn't really mean a whole lot. Not only is there no timetable, but it's not clear what the conditions would be. I think you and Kayleigh were discussing a ceasefire. But what would be the territorial reach of a Ukraine that would enjoy NATO protections? How would that work? What kind of limits might be acceptable in terms of NATO weaponry or forces on Ukrainian territory? So I actually think the conversation about whether and when and how Ukraine might one day be a member of NATO has barely begun.
Who would have that conversation? Because President Biden and Emmanuel Macron of France both face uncertain futures right now.
No, you're absolutely right. They do, as well as the Chancellor of Germany to some extent. So look, it's a political military alliance, and it's hard for the military side to operate absent an equal political side. Plus, as you two were just discussing, there's the specter of Donald Trump hovering above all of this. So quite honestly, we could begin the conversations now, but until there's clarity, whether there's a government of France, more important, what is the next government of the United States, not just the presidency, but the Congress, I don't think these conversations amount to a whole lot.
Yeah. Is it possible for NATO to Trump-proof the aid to Ukraine?
In a word, no. NATO can't really Trump-proof anything in terms of aid to Ukraine, in terms pretty much of anything else. U.S. force levels in Europe, policies vis-a-vis Russia. Under our system, as you know, the President of the United States, the executive branch, really enjoys tremendous discretion and latitude when it comes to designing and implementing American foreign policy. So all this talk about Trump-proofing is really pretty much empty talk.
Okay. And of course, President Biden is not the only wild card here, meaning if he doesn't stick around through next year, because I think about Hungary's Viktor Orban also, in the mix here. OPEC name-checked China in its statement, accusing it of providing weapons parts and other technological support to Russia versus Ukraine. How united is this alliance against China at the moment?
Well, that was interesting. I actually thought that was the most interesting part of the NATO summit, the tough language about China. It's almost as if the era of kind of romanticism about China, which a lot of Europeans, as well as Americans for a while, were part of. That's passed. I think the interesting question now, Scarlett, is what actually comes from that language. China is violating the spirit, if not the letter, of all of its commitments not to arm Russia by giving technology and components. So what now are the NATO countries prepared to do? What will be the diplomatic and, more important, economic and military consequences of this surprisingly tough language? That doesn't seem to have been decided, but I would keep the focus in that in coming months.
Okay, so in terms of looking for follow-up action, we're more likely to see follow-up action on China than on Ukraine?
I think that's realistic. But again, a lot depends upon whether there's a will to match those words. Again, the first time I've seen NATO and the United States and Europe come together with such tough language, be curious to see how the Chinese react, whether they try to diffuse this situation. And if they don't, what are the United States and Europe actually prepared to do in terms of technology restrictions, market access restrictions, and the like?
All right, so the gauntlet has kind of been thrown, and we'll see how China responds. We know that foreign policy is President Biden's area of expertise. He was chair of the Senate Foreign Relations Committee for years. This event should really be Biden's moment to shine, but it has, of course, turned into a fitness test for him. What have you seen, what have you heard from Biden so far at this event?
Look, I think his speech has been fine. We'll see how the press conference later today goes. The communique was pretty much a standard NATO communique. I don't think it'll matter a whole lot, though, because, first of all, Americans are not focused closely or intently on NATO communiques or on NATO summits. It's not going to affect a lot of voting. And we'll see again. I think the press conference will matter more. But again, because of the debate, every time President Biden goes out now, people are sitting there wondering less about what he says than how he walks, how he talks, and the rest. And I'm not sure he can turn the corner on that.
Yeah.
And that's this larger conversation about whether he will step aside or remain the candidate is really the issue of the moment.
Absolutely. After the debate about 2 weeks ago, you wrote the debate and the growing perception that Donald Trump will win in November will turn POTUS into something of a lame duck with more than half a year left in his term. It'll work to diminish U.S. influence with friends and foes alike. What is your perspective on how NATO allies are likely viewing all this turmoil, all these questions about his age and his fitness?
It's incredibly disorienting for them. In large part, it's not simply because of Joe Biden, but taking a step back. In the good old days, NATO could look at the United States, and it didn't matter who won one of our elections. Whether it was a Democrat or a Republican, 99% of the policies towards Europe and NATO would be the same. What's such a departure here is what Donald Trump represents domestically, but more important, his foreign policy is so qualitatively different than the last 75 years of American foreign policy. It's so different from Joe Biden that this is truly disorienting for Europe because alliances depend upon reliability and predictability. And because of Donald Trump, the United States is no longer in the business of being reliable or being predictable.
Yeah, the stability simply isn't there. So I guess just to put it bluntly, Richard, do you believe President Biden should stay running for the president in November?
As I said publicly, I do not. I think he's been a good president. I think he's a really good man. But I do not think he can defeat Donald Trump, part because he's an incumbent. It's a bad moment to be an incumbent that we've seen in all these other elections. In part, his age issue makes him the issue and not Donald Trump. And I think so long as he is the issue and Donald Trump is and his policies are not the issue, I think then Joe Biden loses. So I think for that reason, as well as the fact how demanding this job is, the idea that this Joe Biden could do the job in 4+ years when he's 86, that's a stretch to be generous. So I think if you want to see Donald Trump not return to the Oval Office for a second term, I do think it's incumbent upon the Democrats to find somebody else. And I think Joe Biden should step aside for the sake of his legacy and for the sake of this country.
Thank you for answering that, Richard. Last September, you moved over to join the investment bank Centerview. So I want to get from you your advice to CEOs perhaps looking to make big acquisitions right now. What is the single biggest geopolitical risk that they may be underestimating right now and should consider before going forward with a big acquisition?
I think the biggest short-term geopolitical risk is what we've just been talking about. It's the uncertainty about the role of the United States in the world. We have been such a linchpin of order in the world for the last 3/4 of a century from our entry into World War II. And you can't take that for granted anymore. And I think for the people in the business world, they've got to assume a greater degree of uncertainty. Then you've got the fact of these emerging powers, much greater turbulence in the world. And on top of that, the world hasn't come together to deal with various global challenges, beginning with climate. So all things being equal, it's a fasten your seatbelt time. That going ahead, it's going to be a much more difficult environment, literally and figuratively, for business people to navigate than what they're used to.
All right. Well, thank you so much for sharing your views. Richard Haass, Senior Counselor at Centerview Partners and, of course, President Emeritus of the Council of Foreign Relations. Coming up on Bloomberg Markets, with inflation top of mind for consumers and companies, we're going to hear from the CFO of General Mills on their strategy to keep shoppers coming back. This is Bloomberg. Consumers are fed up with inflation at the grocery store, and that has been a challenge for CFOs like Kofi Bruce of General Mills. A new season of Bloomberg's Chief Future Officer begins this week with a focus on one of the leading packaged food companies. Our Romaine Bostic spoke with Bruce and the CEO Jeff Harmening on these inflationary pressures.
We've had a period where we've gone through once in 50-year inflation, right? It's impacted our cost structure. We're up almost 30% in our cost of goods sold just over the past 2 years. If I dial back to the beginning of the pandemic, almost a third increase in our cost base, almost $3.6 billion, give or take.
The consumers are feeling the pinch of inflation. So even if inflation is coming down, that doesn't mean it's deflationary. We're in this dichotomy where in some ways we're settling into a new normal, in other ways it feels very abnormal and very stressful for consumers.
From 2020 through the early months of 2024, food prices soared 25% in the U.S., well above the 20% rise for consumer prices overall. Food inflation concerns dominated headlines.
Every time Ohioans go to the grocery store,
the Senate held hearings on shrinkflation, calling out industry players for reducing the size of their products without actually reducing the price. It's a challenge many companies have had to address.
There's been a lot of talk about shrinkflation among a lot of the packaged goods companies. How do you go about creating a more cost-effective, both for you and for the consumer, but doing it in a way that's a little more transparent?
We have to do the things first that dampen the impact, right? That don't impact the consumer. If we do our job right and we're driving productivity, that takes some of the sting out because that's costs that we don't have passed back, certainly ultimately to the consumer. But the other job is to make sure that if we've got consumers that are looking for value, that we're hitting them with the right promotions and the right incentives, as well as we've got pack sizes to kind of meet their price point expectations. That's a big part of the job.
All right, coming up, we talk real estate with Samantha Rudin Earls. This is Bloomberg. Welcome to Bloomberg Markets. I'm Scarlett Fu. Let's get you a quick check on the markets at midday right now because the S&P 500 and NASDAQ are falling the most since April. You can see declines of 1.9% for the tech-heavy NASDAQ 100, down 0.8% for the S&P 500. And this is after a fairly cool inflation report. This was an instance of buy on rumors, sell on news, given that the indexes had gained for 7 days straight prior to today. You're also looking at yields going down for both the 2-year and the 10-year. There have been a couple of auctions so far this week, which have seen favorable demand. But of course, the big story here is that slowing inflation does give the Federal Reserve room to move forward with interest rate cuts later this year. Now, speaking of interest rates, let's turn to real estate because higher for longer rates for the past 2.5 years has made commercial real estate a real source of concern, including for Fed Chair Jay Powell. Bloomberg's Abigail Doolittle is here now, along with Samantha Rudin Earls, co-CEO of Rudin, which manages 17 residential buildings and 15 commercial office buildings here in New York City. Let me start with Abigail, who has an overview for us on where the real estate market stands right now. Abigail?
Well, Scarlett, one of the big stories, of course, is the world of pain that commercial real estate is in. But it's not all sectors within commercial real estate, office in particular, a lot of pain coming out of the pandemic, people still working from home, so higher vacancies. And you can see this really weighing on some of the publicly traded office REITs, SL Green, Vornado, which is actually the owner of the building that we are in, and then Boston Properties. Big declines over the last 5 years as those publicly traded companies, those investors have had to be pretty disciplined in terms of the balance sheet and take the losses. That's not necessarily true with a lot of the other office buildings out there. We're all waiting for some sort of move down for office properties, but not a lot of activity in terms of trading. Let's take a look at the delinquency that we're seeing, because a piece of the story, of course, is this big wave of CMBS that's expected to hit $1 trillion, $1.5 trillion by the end of next year. Some are saying coming out of the GFC, we did have delinquencies on CMBS going up toward 10% in, let's call it 2011, 2012, and then down as rates went lower. Well, now we're creeping back up to 6%. But it's not all painful. There's other sectors that are good. But the office part of it, at least, Scarlett, bad enough that we did, in fact, this week hear Fed Chair Jay Powell address concerns around commercial real estate. Let's take a listen.
This is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk.
Let's now bring in Rudin Co-CEO Samantha Rudin. Thanks again for joining us. And that was a great overview from Abigail. I'm curious to hear from you on the 17 residential buildings and the 15 office buildings that you own. What have you seen? What does it look like for you?
Well, thank you so much for having me. And yeah, obviously on the office side, there's been it's been a lot of distress in the office, but we're also hearing the chairman, Powell talk this week, and knowing that as inflation starts to cool and the labor market is softening, the potential of rates coming down in the fall would be very helpful on the office side. But I think it's also really important to focus on, while there are areas where office is struggling, there are also areas where office is doing really well. If you look at Park Avenue, the vacancy is sub 8%. We recently just renewed and expanded a lease with Blackstone for over 1 million square feet. And you see in the office market, again, a flight to quality, a flight to amenitization, buildings that are located in good locations next to mass transit. And so it's not, the story is not all bad in office, and hopefully as rates start to come down, things will start to move more and everything will improve. So we're looking forward to that.
That's really encouraging to hear that it's not all bad. And we've heard that from some other folks who have joined us, that Class A and some of the prime areas, that they really are doing well. So we're glad to hear that that's the case. But something that we keep hearing about is the idea that there's this glut of office, maybe some of the B and C, that can be converted to residential. And I know that you recently sold 55 Broad, but you're still involved, and that is being converted to residential. And you're excited. You're the first person I've heard being excited about it. So talk to us about that.
Yeah, well, obviously with the surplus of office space that is in buildings that are could be repurposed because they're no longer serving as an office building. And in the financial district, conversions have been happening for over 30 years. And since the 90s, it went from 10,000 people living in Lower Manhattan to now 70,000. And we recently sold our building at 55 Broad Street to Silverstein and Metro Loft, and they're currently converting this building that was built in the 1960s to a 571-unit residential state-of-the-art apartment building. It's going to have a full suite of amenities, wellness, and there's going to be a pool on the roof deck, and they really found a way to effectively repurpose this office older building and make it into beautiful market rate housing.
And Nathan Berman, of course, is helping out there, considered to be the maestro and creating that there's not a doom loop down. But let's stick with residential, because that's really your area. And so when we spoke a few weeks ago, and thank you so much for joining Scarlett and I, we really are so happy about this. When we spoke, you talked about the idea that your occupancy right now is at an all-time high for residential, and yet we keep hearing about this inflation, these prices, at what point are New Yorkers going to push back where they're not going to keep paying record high rents and keeping occupancy at record highs as well?
Well, I think the problem is that there's just a real shortage of supply. There's no, vacancy throughout the city is 1.4%. So the fact that there's just not an supply of housing makes it that. And we're a long-time owner here. We have 17 residential buildings, 15 office, and we really pride ourselves on investing in our properties. And we've used this period of time where the demand is so strong to reinvest in our properties, continue to amenitize them, modernize them, and we're hoping and we see the long-term value of New York and obviously multifamily.
You mentioned investing in your properties, but there are certain things that are beyond your control, like public transit. The MTA, of course, now has some money issues, and they have to defer $16.5 billion of capital upgrades because the city and the state are not moving forward with congestion pricing. How do you work around that, given that this is something residents and buyers have to consider, the access to public transit? Yeah, no, it's a huge issue, and hopefully, congestion pricing can somehow get reworked, because it would really be a huge, it's really important that our transportation system functions right. It's essential.
Well, Samantha, I just have to also mention your family, because the Rudin family, of course, is a storied New York family. And I know that your grandfather started the company about almost 100 years ago. Next year will be your 100-year centennial anniversary. So what do you do? Because I know that you do so much to really help the city, preserve the city. We came out of the pandemic. We seem stronger than ever. What are the things that you are really focused on right now?
So our company is about to celebrate its 100th anniversary in 2025, which is a huge milestone for us. And, all of these shifts in the market and cycles, the upturns, the downturns, we've been able to ride through them for the last, 100 years. So we take a long-term outlook on the city, and we also see the importance and value of constantly giving back. And my family has believed that if the city doesn't do well, if the city's not doing well, then it will have an impact on our business. And so we give back to whether it's hospitals, schools, parks, the arts, all different organizations to help infuse the fabric of the city. And we see that as, what is really important for the long-term success of New York City.
All right, Samantha Rudin, Earl, and she is the co-CEO of Rudin Management, and Bloomberg's Abigail Doolittle. Thank you both so much.
Thank you.
Really appreciate it. Coming up, we're looking at shares of Tesla. They were on a tear in recent weeks, but a new Bloomberg report is sending the stock plummeting. A quick check also on where stocks stand overall. We're seeing selling pressure on the S&P and the NASDAQ today, with the NASDAQ off by 1.5% on pace for its biggest decline since April. This is Bloomberg Markets. This is Bloomberg Markets. I'm Scarlett Fu. The Biden administration is giving out $1.7 billion to retool U.S. auto plants for electrification. This grant affects facilities across 8 states and is part of a program from the White House's signature climate law, the Inflation Reduction Act. President Biden has set a goal of having 50% of all new vehicle sales be electric by 2030, as well as bringing back domestic auto parts production from foreign countries. Now, speaking of EVs, some of which is made in the U.S., that brings us to our stock of the hour, which is Tesla. Bloomberg reporting that Tesla plans to delay its Robotaxi unveiling till October. We saw the shares turn sharply lower on the news. Prior to that, Tesla stock was on its longest winning streak in years before this report came along. Let's bring in now Bloomberg Technology co-host Ed Ludlow for more from San Francisco. So Ed, this Robotaxi, which has been talked about for so long, has really become the focal point for Tesla investors, and this idea that Tesla stock can recover from its stumble over the past month, over the past year.
Yeah, and that probably speaks to the severity of the decline after we published that report. So what Dana Hall and I are hearing from sources at Tesla is that they're basically just not ready. They wanted more prototypes of this purpose-built robotaxi to show at the event, it had been sort of loosely scheduled for August 8th because Elon Musk had posted on X that it would be August 8th. It's delayed by 3 months, which doesn't seem like such a big deal necessarily, or a couple of months. But what we're hearing is that's the impetus here. They want more to show for it. The stock, I mean, down 6%, that seems like a lot. But because at the heart of the bull thesis is the idea that autonomy and an almost Uber-like service is a great proportion of Tesla's future revenue.
And this has really been something that Elon Musk himself has chosen to focus on, as opposed to talking about Tesla's production numbers and the fact that sales have been cooling off. And this has been driving the stock's 11-day rally.
Yeah, and the other day he responded to a user on X who was responding in kind to the Tesla second quarter deliveries. And Musk basically said, deliveries are a very small part of what our future is going to be. What's interesting on like the reaction in the shares to this delay of the event is that Elon Musk's own attitude towards autonomous driving has evolved. So originally the idea was that you would lease a Tesla vehicle, a consumer car, and it would have all the hardware and software you need to drive autonomously. And when that lease ends, you give it back to Tesla, and they kind of create this fleet they control. Or something like Airbnb, where you have your consumer car, and when you're not using it, you put it on Tesla's platform, and off it goes. At the beginning of the day to be a Robotaxi. The latest iteration was a purpose-built Robotaxi. And I think the street was saying, well, show it to us then. And so a delay is kind of a question on what it will look like and how long it will take to materialize.
Yeah, and again, we're seeing Tesla shares as the worst performer among the Magnificent Seven, losing 6% right now. Now, in contrast to Tesla, which is falling today, I'm looking at Rivian, which is seeing its fifth straight day of gains, now up 2.2% on the day. You recently co-wrote a story about Rivian for Bloomberg Business Week, really starting with this idea that Rivian has a new plan with Volkswagen that's helping its stock recover a lot of ground. Just walk us through it.
Yeah, I've covered Rivian for many years, and long story short, because we wrote 4,000 words about it, they've just hit the reset button. They've rethought how they're going to go from being basically a niche player to a mass market player. Volkswagen has agreed to invest up to $5 billion into them through 2026 and form a JV, and they desperately need that money. They've had some problems getting access to loans which were made available by the IRA, and they have a new plan, which is instead of a shiny new factory in Georgia being their future in the first instance, they're going to launch a mass market car from a plant they've already got in Illinois. They already, it already exists and it works, and it's all about the pressure to scale quickly. And we get really inside the CEO, RJ Scarin's head. So I'm going to post a GIF link on X. Max Chafkin, the co-byline's already posted a GIF link. Get out there and read it. 4,000 words. What better way to spend an evening, morning, lunchtime, or weekend?
Yes, I spent my morning reading it as well. Tesla, obviously, a big part of that story, too, because a lot of the Rivian fan base are former Tesla fanboys or fangirls who have decided that Rivian fits them better, right? Tesla is no longer about the EVs. It's about Elon Musk and the cult around him.
Yeah, it's multifaceted, but in the first instance, with its first generation consumer cars, the R1, loads of those first buyers were former Tesla buyers. But it goes beyond that. They're people that may have been disillusioned with Elon Musk, frankly. Not everyone. There are people that just looked at Rivian and said, I don't want a small Model 3 or Model Y. I want a big old SUV with 3 rows, or I want a pickup. So they went and bought the thing, electric version that they've already driven for years, whether they were driving gas pickups. Now the question for Rivian is, well, that market's kind of been taken now. You're battling with Tesla for the kind of enthusiasts. The mass market is where you're battling Toyota and the RAV4 or Honda and the CR-V, and that's why they need this R2 at the same time that Tesla's also trying to extend its lead as the incumbent.
Yeah, it's a dogfight for sure. Ed Ludlow, thank you so much. Bloomberg's Ed Ludlow, and be sure to check out his article in Bloomberg Business Week. You can do that at Bloomberg.com. All right, coming up, we're taking a look at big bank earnings, which begin tomorrow with a pickup in commercial loans, sparking some questions about second half performance for 2024. And this on a day where the stock market is in retreat, certainly if you look at the S&P 500 and the NASDAQ. But take a look at the Russell 2000, up 3% right now. A bit of a rotation here as investors come out of the big cap names, especially the growth names, and move into some of the smaller, more ignored names. Within the Russell 2000, all 11 sectors are higher, led by healthcare. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We're going to look ahead to tomorrow because JP Morgan Chase, Citigroup, and Wells Fargo are going to be kicking off the results for big banks. According to Bloomberg Intelligence, fees to power momentum going into the second half of the year will certainly be a focal point. So I want to bring in now our finance team, our powerhouse finance team, Bloomberg's Shunali Bassick and Catherine Doherty, for a little bit more. And we'll start off very quickly, Shunali, with just the bank earnings and what you're looking for in terms of the capital markets business, investment banking, fees, and trading from equities and fixed income currencies and commodities.
It's a good question in this environment because obviously a lot of people have been expecting for investment banking to seriously jump back. Underwriting in particular, debt underwriting has been super hot. Equity underwriting has been coming back. M&A has still been a massive question mark. So what does that mean for the banks? Will their businesses really sustain themselves into the end of the year? We have an election cycle coming up. If anyone else has been paying attention, I think there's a lot of question around the numbers you see this current quarter, the third quarter and the second quarter, really meeting up to what you would think through the end of the year. So what they say in their calls about that growth will be important.
Absolutely. So let's bring in Catherine into this conversation because I bring up capital markets and trading because we always kind of look at that to get a sense of the health of capital markets. But you've been covering Citadel Securities and its new strategy to shake up banks as trading desks. What's going on with Ken Griffin and Citadel Securities?
That's right. So this is not the biggest banks, the ones that we're going to be following tomorrow when they start reporting earnings. These are the smaller banks that are struggling to compete with those big players. Why are they struggling? Costs continue to rise, commissions are compressing, and so how can you compete when you can't invest in your technology and keep up? So that's where Citadel Securities is seeing an opportunity to partner with some of these banks and brokers and essentially provide the services that they've built, they're using in-house, and they find some strategies here that they're still developing in order to give those banks and brokers a boost so that they can stay in the game and not only stay in the game, but really compete and hopefully grow market share for themselves and continue to serve their clients.
Hey, you know, what's interesting about this as well, Catherine, is this whole idea of this is all coming out at a time where the Basel III endgame rules have not been finalized, and they could include very significant restraints on the trading desks.
That's
absolutely true. This was born, right, from what I understand, out of this idea that capital requirements have been making it tough for banks to trade at length.
And Citadel is seeing that opportunity to come in and say, well, as you are dealing with these constraints, we can help and we can alleviate some of those pains elsewhere and make sure that you have further capital to have flexibility and again, stay and compete and continue to gain market share.
So that raises an interesting point. I'm glad you brought up Basel III in because we know from Fed Chair Jay Powell that they're still working on coming up with a revised proposal there. How quickly can the Citadel Securities plan come together?
I don't think this is going to be quick by any means. This is something that is going to take a lot of time, a lot of deliberations. The conversations, they need to develop the trust with their partners. The partners need to develop the trust with Citadel. And Citadel really needs to be able to demonstrate its own risk management and what that means for them in managing their own balance sheet. And those are all things that are going to need to be developed over time. It's not an easy feat. So it's not something that they're going to turn the switch on and it's going to just happen in the next quarter or so. I think that this is going to be a developing story that we're going to be following over time.
There's this weird frenemy thing going on in the market with Citadel Securities and the banks too. Let's point out the elephant in the room here, because on one hand you have Citadel Securities, and anyone at Goldman or Morgan Stanley will tell you that they've noticed Citadel Securities get bigger and bigger in the game of market making, and now they're going to the banking industry and say, hey, let us provide you a white glove service. And so it's interesting. You had mentioned this is more for small and mid-sized banks. It's worth just pointing out for a second too, I mean, how big Citadel Securities has really gotten in the world of trading and the ambitions they have to expand.
That's right. It's going beyond retail trading, which is really where they came into the prominence, the meme stock craze. Before, you would walk down the street and mention Citadel Securities. I'm not sure many people would pick up on that name. Now, it is very much in vogue. And so, but they're building beyond that retail presence and continuing to deepen their relationships with institutional clients, with these banks and brokers, and the buy side, some asset managers and pension funds, those investors that are looking to Citadel for their services.
All right, good stuff. Catherine Doherty, by the way, this is the most read story on the Bloomberg terminal. Citadel Securities crafting a plan to shake up Banks' trading desk. And of course, Janali Bassett, co-host of Bloomberg Open Interest. Thank you both so much. All right, let's get to where the markets stand, because at midday we are looking at a decline here across the board for the big caps. Certainly when you look at the S&P 500 and the NASDAQ, the Dow is little changed as there's a rotation into some of the long ignored sectors of the market. And the Russell 2000 up 3% on the day as investors switch to some of the small caps that have been long ignored. That does it for Bloomberg Markets. I'm Scarlett Fu.